Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Best Buy, which is one of the biggest companies in the cyclical consumer sector. Last, they generated a revenue of $51.8 billion and they have a market capitalization of $17.3 billion. The revenue of Best Buy can be divided into 5 main segments, which are computing and mobile phones with 44%, consumer electronics with 31%, appliances with 14%, entertainment with 6%, and services with 5%. The revenue can also be divided geographically. It is informed that 92% of the revenue is made in the US and 8% comes from international sales. When going through the annual report of Best Buy, it can be seen that they mostly don't own the locations, but mainly rely on leasing the locations. It can also be seen that they only have international locations in Canada. They had locations in Mexico as well, but the last 4 locations closed in 2022. If you want to know more about the revenue, you can check out the annual report of Best Buy, which I have linked down below. Enough about the introduction. Let's find out if Best Buy is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Best Buy is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.32%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Best Buy is 10.5%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value, I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Best Buy is 10.5%. This value is in the yellow section of a rating scale, and therefore the margin of safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 36 cents were paid, and in 2022, $3.16 is expected. Best Buy has paid and increased the dividend for 14 consecutive years, which makes them a dividend contender. In the last 5 years, the average dividend growth was 23%. A dividend growth of 23% is a very good value, and in the dark green section of my rating scale. Therefore, I subtract 10% from the margin of safety. By looking at the payout ratio, I find out if this high dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Best Buy has increased from $1.6 billion in 2018 to $2.5 billion in 2022. The cash dividend were respectively $0.51 billion and $0.79 billion. The average payout ratio thereby becomes 26%. This value is in the green section of a rating scale, and therefore I subtract 5% from the margin of safety. Before we continue the analysis, I would like to remind you that if you like my stock analysis, you can support the channel by liking the video and subscribe to my channel if you haven't already. If you also would like to support me financially, you can check out the links in the video description, where you can open new portfolios or buy some great investor books. With that being said, you can of course also just continue to watch my videos, which is a huge support already. But now, let's get back to the analysis. Next, I'll take a look at the debt situation. The company has a debt of $3.9 billion and have $1.4 billion in cash. Then the cash gets subtracted from the debt, and this value then gets divided by the EBITDA. The debt to equity ratio is found. The EBITDA is currently at $4 billion, which leads to a debt to equity ratio of 64%. This matrix tells us that the company could pay off the whole debt in under a year if they wanted to. This is of course a very good value, and for this matrix I'll subtract 5% from the margin of safety. For the business to be sustainable, growth is a very important factor. The revenue has increased from $42.2 billion in 2018 to $51.8 billion in 2022. This gives an average growth of 5.3%. In the same period of time, the EBIT increased from $2 billion to $3.1 billion, which gives an average growth of 12.2%. The margin is found by dividing the EBIT with the revenue, which in 2018 gives 4.6% and in 2022 increased to 6%. Since the EBIT increases at a higher rate than the revenue, it only makes sense that the profitability of the company increases. In this case, it increases with 6.6% in average. An EBIT growth of 12.2% is in the dark green section of a rating scale, which gives minus 10%. And I'll subtract 5% from the margin of safety for an average margin increasement of 6.6%. The last thing I'm looking at is the potential yield on cost. This matrix tells how great a potential investment in Best Buy would be and what annual income I could expect in a few years. Best Buy have a dividend yield of 4.1% and a dividend growth rate of 23%. I assume that the dividend gets fully reinvested at the same conditions. But I'll subtract 15% from every dividend payment because there are 15% withholding taxes for stocks from the US. After 5 years, the yield on cost would be 17%, after 10 years it would be 131%, and after 15 years it would be 6,030%. I only calculate the potential yield on cost for the coming 15 years because of the natural uncertainty of this matrix. And Best Buy is a good example of this uncertainty. Of course the yield on cost in 15 years won't be 6,030%, because the high dividend growth rate most likely can't be maintained. But it still indicates that the yield on cost in 15 years could be pretty decent. And for this matrix, I'll subtract 10% from the margin of safety. Since every matrix for my analysis has now been collected, it is time to adjust the margin of safety. Minus 10% for the dividend growth, minus 5% for the payout ratio, minus 5% for the debt, minus 10% for the EBIT growth, minus 5% for the margin growth, and minus 10% for the potential yield on cost. Thereby, the new margin of safety becomes minus 20%. This leads to a desired dividend yield of 1.86%. And by a current dividend of $3.16, I shouldn't pay more than $170 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Best Buy is $136. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve which always lies 20% under the historical yield. As seen in the graph, the historical yield and the margin of safety are under the yield curve. Therefore, I consider the stock as undervalued. Finally, I consider the stock at its fair value when the price is $136. I will buy the stock at $170, and the stock price is currently at $77. That's it for today's video, and thank you for watching.